First rates Wednesday morning on your screen, they will just start popping up, and you've got a cut of 50 points on the Nifty, and this in line with what SGX was indicating. And for the index per se, it's an even Steven market breadth. So we are off to a great start. The breadth is weak, markets are weak. Adani group of stocks, they continue irrespective of what is happening in the world, because they are in a unique position in terms of where the momentum and where the positioning is. So Adani group of stocks, they continue to flare selectively, not all of them actually. Adani Enterprises is the one which is flaring up, Ports is flaring up, Adani Transmission locked up, Adani Green should be locked up, Adani Wilmer also, I don't think there is energy change per se. Some numbers which are important: number one is Metro, second is Dixon, third I would say BKG, and fourth I would say Fortis. These are four numbers which from the mid-cap space are going to be important. Metro down, Dixon up, BKG Foods up 10 rupees, and then you've got Fortis where numbers are in line but margin expansion has been decent, and the stock reaction on the screen 290.
Right. Let's see what Sun Pharma is doing right now, what the Adani group of stocks are up to, Adani Enterprises, Adani Ports, Ambuja Cement, Wilmar. The entire pack is still seeing a bit of a follow through. Of course, the gains are a lot less than what we had the last three trading sessions. Biocon as well came out with a good set of numbers. The numbers have managed to post a beat. The EBITDA has seen an uptick of nearly 68.5%. A big move on Biocon this morning. Over 5% is the kind of surge that you're seeing on the stock price. NMDC as well, the results were largely above estimates. The Q4 sales volumes as well have come in higher. Ashok Leyland, Dixon Technologies, they're all reacting to their numbers this morning. NMDC though is a little bit quiet. So is Ashok Leyland, down about 0.6%. Dixon higher by 0.5% as we speak. Varun Beverages, that's the other stock which is in news this morning. They've incorporated a company in South Africa to explore manufacturing and distribution of their businesses. Varun Beverages 1.5% higher. Fortis, Amara Raja, they all came out with with decent set of numbers. We're going to be chatting with the Fortis management as well, although Amara Raja is down 1%. But the margins have seen an uptick of about 380 basis points. And for Fortis as well, the net profit has jumped up 59% on a year-on-year basis. Let's see what the other earnings reactions are with JSW Energy, which has not been the best of set. There's Metro Brands as well, which came out with its numbers. We just flagged that off as well. Let's see what Metro Brands is up to. A gap down, 4.5% lower for Metro as we speak. Sequin, Galaxy Surfactants, these are all numbers which came out yesterday post-market hours. So let's see where the Nifty is finally settling in at. Marginally soft. The future still holding on to 18,300. Biocon, Adani Enterprises, Manappuram, these are your big star performers. Having said that, one of your biggest drags also within the liquid universe is Adani Ports, 1.5% lower there. Kunal, what do you make of trades so far, and any trades that you're punching in?
Yeah, so I think we're back at 18,400 as a range for the index. So I think we are almost at 18,300 levels, which means we are more or less there within the range. The sector trend which we need to watch out for is whether there's unwinding of large cap IT names as well as push towards the PSU banking stocks or the private sector banking names or not. Now, the stock which I would look to initiate would be Bank of Baroda. I believe that the stock has made a good comeback in the last couple of days, bouncing up from 176.78 to 180, 182, where it closed yesterday. So that's a stock which looks interesting on the charts.
Nooresh, let's get in a quick call as to what you're looking at as your first trade this morning.
So staying a little defensive, continued like ICICI Bank, that's a stock on dip today at 940, 945 would be interesting buy. Overall, looking at it to cross the 52-week highs around 960 mark and slowly go towards 1,000, 1,050 levels. So ICICI Bank is the one which looks interesting.
Manish Gunwani joins us. Let's connect with him and let's talk markets and let's understand that what he makes of the current market action. Manish, good morning. Thank you for joining us. First time I think we are talking to you in a new avatar.
Yeah, thanks for having me.
How's life changed?
All good, all good.
Yeah. Life has changed, profile has changed, have portfolios also changed?
Not really. I mean, I think since 1.5 years, generally, I've been in favor of domestic companies rather than global companies. And I think that has not changed. Preference for sectors like banks, industrials, cement, or auto versus global sectors like IT and metals is broadly where we are. So not much in that sense, yes.
Are you surprised with the way our markets have made a comeback? Almost 1,500 points on the Nifty, 4,000 points on the Bank Nifty.
Not really, Nikund. I think a lot of it has to do, to my mind, with two or three things. One is your external account situation obviously has gone through a sea change because energy prices are down, service exports have done well, the dollar itself has weakened. I guess the single most important variable for emerging markets, even probably bigger than Fed, is the dollar trajectory. And DXY has come down from 114 to 102. Now it's gone back to 103 odd. So the fact that dollar has weakened, bottom up, we have a service export story going. Your biggest import energy is down 25-30%. So the macro outlook, especially on the external accounts, has substantially changed for India. So in that sense, I'm not really surprised that the market has displayed a bit of strength recently.
Manish, hi, morning. Just going by the kind of data we've accumulated with respect to the earnings season gone by, it seems that majority has come in line with what the street was expecting. How have you assessed the overall earnings performance, and do you believe that this strong earnings growth is likely to continue?
So first of all, when you see the situation globally, earnings coming in line is actually a good thing because most countries, most economies, most markets, earnings have actually been downgraded, including the big ones like US, over last 12 months. Now, in that sense, I think, which is one of the reasons why I think the Indian market has done well, is both from the last 12-month perspective and the next 12-month perspective. I think India's earnings are proving to be much, much more resilient and robust versus most of the other emerging markets, at least. So given that a lot of our earnings are coming from sectors like private banks and FMCG and cement and telecom and utilities, I guess 60 to 70% of our earnings look reasonably safe over the next 12 to 15 months. And that, I think, kind of gives India a bit of premium globally. So I don't think at this point, unless you see the tail risk of this whole global monetary tightening resulting in a massive slowdown globally or a financial credit event happening, a financial crisis kind of event happening, I think most of the earnings, when you look at Nifty 100 or Nifty 200, are coming from market share gains. So we're not betting that, India's growth is going to be phenomenal because obviously when the globe is slowing down, that will affect India's growth as well. But if you see the big components of the Nifty 100 earnings, either they're getting market share like private banks or like telecom, it is a consolidation play. So there's a bottom-up phenomenon here about earnings rather than saying that India's nominal or real GDP is going to escalate too much. In that sense, the earnings look fairly resilient. Also, the fact that from 2013 to 20, till the COVID period, you had a very weak base for banks, autos, capital goods. So that tailwind still exists, I think, in just terms of reversion to mean, which may last for a couple of years more. So I think all this is leading to a situation where, in spite of a lot of patchy data globally, and in a normal world, a global slowdown does affect India in terms of both the economy and the corporate earnings. But this time, that link is relatively weak to my mind.
Manish, what I see from your portfolios is that large cap IT also makes its way. Wanted to understand how you reacted to when the disappointments came in, especially from the larger boys within the IT pack this quarter itself, and whether in the recent dip you've been a buyer or not.
No, so at a house level, we are still underweight IT. And as I said, our general preference has been for domestic sectors rather than global sector like IT, metal, etc. Having said that, obviously the stocks have corrected reasonably sharply over the last 15, 18 months. And a lot of them do look interesting at this point of time. So we are obviously looking at it from buying bias rather than selling bias. But obviously, we kind of being calibrated about it versus the US slowdown. And also, I think we need to be careful about a couple of things in that sector. One is, of course, more recent worry about AI, how much of low-end work it cannibalizes. The other is that the non-listed IT companies, the captives and non-IT back-end centers, they seem to be growing, which shows up in service exports data, right? I mean, that's the big macro story for India at this point of time. Now, if that leads to a currency which is stronger than traditional 3 to 4% depreciation versus dollar on a structural basis, I'm saying on a 3-5 year basis, and the fact that you're fighting for the same talent which the capitals are fighting for, which means that the wage pressure may not go away, which it typically does in a slowdown. You just need to be careful that the margins don't get affected. But I do agree that on free cash flow yield in terms of ROE versus price to earnings, they are looking more and more attractive.
Interesting. And of course, in the last 2-3 weeks, we've seen a lot of IT majors come out with announcements on AI and how they're now catching up with the trend. TCS as well as Wipro have both partnered with Google Cloud, and Infosys just yesterday launched its AI first offering called Topaz as well. So yeah, this place never has it dull. There's always some development or the other. But that aside, Manish, the other pocket is also private banking names. Over the last few weeks, we've had a whole host of market opinion where a part of the market believes that the best of margin expansion for banks is behind us. What do you have to make of this?
No, clearly. So when you look at the ROA or ROE of the sector, its previous peak was 2010. It's kind of taken out that peak right now. So I would say that in banking, you can't be bullish at a very, very broad level. I think you have to take your bets. And I personally think that the time for low quality banks multiple expansion is probably the best time is behind us. So I think the large banks which are structurally well placed versus the smaller banks or the smaller PSU banks, to me look more attractive from a 3-5 year basis right now. Because the real cheapness of the small banks or the small PSU banks has gone away in the last 2 years. So there might be some juice left, but I think that's the last phase. So on a medium to long term perspective, I don't think having a big weight in low quality banks looks like a good risk reward at this point of time.
Okay. What about your outlook, Manish, on what the potential negotiations with respect to the debt ceiling could emerge as, and how do you believe the talks will likely pan out before the 1st of June?
Well, to be honest, I don't even read about it because I have no insight what will happen. Obviously, common sense dictates that they should reach a compromise at some point, and it typically happens that you go to the last point and then it happens. But really, I think apart from creating some noise, it will not really change our fundamental investment view.
A lot of themes which are at play, and every market will have multiple themes. The small themes, same time last year, were hospitality. This time it's hospital. It was railways, defense 2 years ago. It was railways 6 months ago. Now it's electronic manufacturing. What is the niche theme you are betting on?
So honestly, from a bottom-up perspective, it's not a cheap market, and so I'm not saying that there are consumer themes or industrial themes or export themes which or China plus one kind of theme. I don't think there is anything cheap out there. Nothing is too expensive either, which is why I think the more thematic view is that the domestic economy momentum seems to be holding up much better than the global economic momentum. There is, as I said, a, a fairly significant macro improvement for India in terms of external accounts. So I don't think you can take a view that I will be in consumer or I will be in industrials or I will buy high ROE companies or I'll buy low ROE companies which are cheap. I think a lot of the factor alpha, if you can call it that, with growth versus value, momentum versus content, I think that is gone. I think it's all about every sector, every part of the market, you just work hard and get bottom up alpha. I don't think there is any big theme, which at least to me, maybe I missed out something, but I can't see one big theme out there actually.
Markets are not cheap, and if earnings is expected to grow in the region of 12 to 13%, maybe with a mid-cap stock, it could be 14 to 15%. Do you think we should maximum expect now 12, 13, 14, 12 to 14% return from here for next 3 years?
Yeah, I think that's a fair statement that, I mean, nominal GDP of 11%, corporate earnings slightly above that, and that's the market return. But I just think that, and this is maybe just a gut feel, that because people are very cautious and bearish, it could happen that the next 3-year return may be a bit front-loaded.
Fund managers had to beat the benchmark. Now they have to beat chat GDP. Your business is only getting more and more competitive.
Yeah, but that's the fun part. I mean, it's simple economics that basically the more the money gets institutionalized, the more competitive it will be. So yeah, I mean, but that also makes the game more interesting.
Microfinance business good to invest in, not Bandhan, but now that you are part of that group, you understand the business. So as a fund manager, would you buy a microfinance business?
I obviously can't comment on single stock, but yeah, we've held, at least as a fund manager, I've held microfinance businesses. And just like any other cyclical business, I think there is a point, there is a price at which you should buy it, and there is a price at which you sell it. It is obviously, because it's very volatile, it's not your classic buy and hold kind of sector, but yeah, I think it's inherently a very profitable business. So if you see the ROE or ROA, it is quite high. So you would not think of a business if on a 10-20 year basis, there is a technology disruption or fundamentally its ROE is not more than 12-13%. But this is not, microfinance is not a business where there is a lack of ROE. It's just that the ROE tends to be very volatile. And that actually is a good business to think about from an investing perspective.
Okay, thank you for joining in and sharing with us your outlook, Manish. It's been good having you on board with your take on the markets. A quick check-in as to what the index is up to. Well, despite the fact that we are pretty flat around the 18,300 mark on the frontline index, it's the broader market that's showing you a sliver of green right now, so continuing to remain flat. But let's put the spotlight then on Fortis Healthcare. It's been nothing short of a healthy quarter gone by. Let's talk about their expansion plans, outlook on margins and their guidance. We have with us Dr. Ashutosh Raghuvanshi, Managing Director and CEO at Fortis Healthcare. Thank you so much for taking time out. Dr. Raghuvanshi, to begin with, let's just talk about the outlook then on your individual businesses in terms of the surgical revenue contribution as well. That's gone up from 53% last year to about 59%. What is the outlook in terms of margins here, and do you think that we will see the revenue contribution increase?
Yeah, so the surgical revenue is likely to remain in the same trend. But as parallelly, we have seen that our ARPOB growth has also been very healthy. So we expect a margin expansion. We have repeatedly said that we expect to go to a better margin of about 19 to 20% within a year's time. So we certainly expect that the margin will grow from here. I think as far as the case mix, surgical versus non-surgical is concerned, I think this trend will continue, but typically about 40% revenue is likely to come from non-surgical work.
Business as well, Dr. Raghuvanshi, separately, and the kind of ratio that you have B2C as well as B2B. Wanted to understand whether going forward the focus would be more B2C as a segment.
Yes. So last couple of years, our focus has been on B2C, and we have increased our customer touch points in a big way. The net increase in the customer touch points is almost to the tune of about 800 net growth. So we are, by doing that, we are increasing the component of the B2C, as well as increasing the efficiency of our labs so that we can get more efficiency in terms of our operations. And as a consequence of that, we could expect better margins. Diagnostic business in general has been under pressure. And there was a lot of tailwind last year from COVID. Now this year, if we see that the growth has come only on the non-COVID segment, which is about 12%, and in the COVID segment is completely gone. And as a result of that, the numbers are slightly lower.
Raghuvanshi, good morning. Nikunj also joining in. So nice to connect with you. I just want to understand the big picture with you, Dr. Raghuvanshi. Occupancy levels have gone up from 66% to 67%. Even the occupancy levels are still below what historical averages were. You are looking at a brownfield expansion of about 5,400 beds. What we are trying to understand from you, that what gives you the confidence when occupancy levels are still below 75%, you're looking at expanding?
Yes, very good question, Nikunj. We definitely have occupancy levels different in different hospitals. As part of portfolio, on an average, it is 67%, which is a tad lower than what we had anticipated. In the beginning of the year, I had said that we would expect the occupancy to be at least 70% level. So that's definitely disappointing. But the reason why we have occupancy at a blended level slightly lower is because some of the hospitals in the group have lower occupancy. But the expansion is confined to those units which are currently functioning at the occupancy rates of about 70 to 75, and some of them even 80%. Primarily, this is in the NCR region. Other than that, we are also adding capacity in Mulund, 100 beds, which is actually ready and is in the early phases of commission. So we are very confident that this capacity will be absorbed. And then, as you're aware, that this is brownfield expansion, so it would immediately sort of get absorbed. And at the same time, the profitability of the existing hospitals, because of the scales they will achieve, will also improve significantly.
So, Dr. Raghuvanshi, the entire healthcare landscape is changing. Big national change like Fortis, they are expanding. PE-backed hospitals are looking at expanding into smaller towns. There used to be a town when national big chains would get a lot of medical tourism, if I may use the word, from smaller town to metros. That is changing, and that's a very important change. How will that change life for Fortis? Because now that smaller towns are getting serviced by new chain of PE-backed hospitals.
Certainly, their trend is going to continue. more and more care is going to be provided in smaller towns, and that's how it should be. The impact of that is clearly in terms of the kind of patients which come to tertiary centers. The tertiary centers gradually sort of convert into quaternary centers and are doing only the most complex of the work. And that reflects in our RPOP, that reflects in our surgical numbers going up. And I think that trend is here to continue. And that's precisely the reason why we are investing in higher technology and scaling it up further, starting new services where a lot of infrastructure is required, a lot of expertise is required. These may be one-off procedures, but these procedures contribute in a big way, and at the same time, this is the segment which will, in all likelihood, not develop so well in the periphery, at least in the next decade or so. But I think it is a very healthy trend that tier 2, tier 3 cities are getting most of their healthcare needs taken care of there.
I've tracked had margins of 20% plus, but they're below 20%. And then there are a lot of headwinds suddenly for the sector. One, we understand that there is a big attrition which is there when it comes to doctors and nurses. We understand that the commission structure between hospitals and doctors because of lack of talent is getting renegotiated. Do you think there are some structural manpower related issues which could hit your numbers for FY24 and FY25? I mean, is it similar to what, let's say, IT sector had to face 2 years ago?
No, I have a slightly different view on this. You're right that the attrition amongst the nurses is high and is likely to continue in that level. But there are many mitigating steps which we are taking in terms of preparing the nurse practitioners and also giving nurses career pathways which will help us to retain them with us. Like, for example, this year we have sent 18 nurses for a course at the TIS Center for becoming operational leaders. So that encourages nurses to stay with a group like us, and that is what we are doing. As far as physicians are concerned, the larger chains do not find it as challenging as the smaller chains and the smaller towns. So I don't see a challenge over there. Last few years, the medical education reforms have led to a situation where more and more specialists are being produced. And as we go into the future, this problem will become even less. And at the senior level, we have seen very, very low attrition. The admitting doctor level, we have seen an attrition of only about 7%, which is quite satisfactory.
When I look at your stock, every time I speak to some investors, they say the following: look, till the time there is no clarity on the court issue, we would refrain from buying into the Fortis stock further. How would you address this? It's a valid concern. You'll appreciate that.
It's an absolutely valid concern, and it is very frustrating for us as well. But at the same time, I must say that the investors should look at the performance of the company and how we are not letting those overhangs affect us. And at the moment, we are evaluating various corporate actions which we can undertake. Our belief is that the Supreme Court has removed all those embargoes, and the rest of the corporate actions will follow. We have recently made an acquisition, as you're aware, and that was a small acquisition, but that is in the right direction, and that's a signal that we are capable of growing further. And this overhang does not mean much to the operational efficiency. And this is the first time Fortis has declared a dividend as well. And we expect that we will continue that trend and improve on that as we go in future.
So final question, Mr. Raghuvanshi. Hypothetically, if the open offer would have sailed through, it would have been just a technical overhang where the court would have allowed the minority shareholders to tender the shares. But now that the open offer has not sailed through, technically and both in terms of business operations, has anything changed? Will anything change if the open offer goes through?
The open offer change goes through, the sentiment will change. But as far as the ability of the company to grow and operate is concerned, I think there are no impediments to that. And we strongly believe that we have been put to a very unfair situation here by a dispute with which company had nothing to do. In this situation, I think we have demonstrated that the company is healthy, it is growing, and it would make marginal difference. The sentiment would improve, and I think that is what is also necessary. So I am hoping that the legal system will work fast and resolve this issue once and for all.
Dr. Raghuvanshi, really appreciate your time. So glad you could join us.
Thank you.
And for a change, Dr. Raghuvanshi, we're not talking COVID. Feels very refreshing.
Thank you. Let's hope it remains that way.
Bikaji Foods, from hospitals to snack or the fast food snack market, what's happening there? They've come out with numbers. Rishabh Jain, Chief Financial Officer, and Manoj Verma, Chief Operating Officer, they both join us. So good morning to both of you. Thank you for joining us. I'm going to start with you first, Rishabh. For 2 quarters on the trot, there is a sequential drop. So if I look at the year-on-year number, the revenue is growing. But if I look at the sequential numbers for 2 quarters, there is a drop. Why there is a year-on-year surge and why there is a sequential drop now for 2 quarters?
So if you look at last couple of quarters, so there's quite a seasonality you would see. So quarter 3, if you look at, is quarter 2 and quarter 3 are very high, and that is on the back of Diwali, and we have a huge contribution which comes from our gifting and our sweets portfolio. That's the reason. So I think it would be fair to look at quarter on quarter, because that's like to like comparison or apple to apple comparison to make.
Your margins have gone higher in a tough quarter where other FMCG companies have suffered. Is it largely because you were hedged in terms of your cost of raw material, largely staples and then oil?
So basically, you'll see compared to first quarter, where we've seen a key inflationary pressure in all the edible oil prices or key raw material. But post first quarter, we've seen very much deflation in all the palm oil prices, including all the key raw material, like all the pulses thing. So in last quarter also, we've seen substantial gain in all our raw material, and that's how we have gained a good gross margin in last quarter.
And to add to what Rishabh said, this tough times helped us learn good things, and that's where we thought of bringing in efficiencies across our cost centers, and that has helped us as we move towards quarter 4 or towards the year end, and I think the year to come would be even helpful for that.
Okay, interesting. So Manoj, help us understand what kind of volume growth are you penciling in yourself for the fiscal year forward?
So in the year to come, what we look at it is that it would be, so your value and volume growth would be in line. So unlike the yesteryears where the value increase has been by far higher than the volume growth, that's what we look at. And rest, there's certain things which are unseen. But I mean, for all our budget purpose, for all our planning, we are looking at that as value and volume growth as same.
Yes.
Right. Manoj, do you also then work with, your SKUs range? Because as I understand, from small packs of about 14 to 18 grams to family packs of 1 kg, I mean, you've got a wide variety. Are you sensing at all that the consumer is getting a little bit price conscious and therefore you will have to focus more on the smaller SKUs?
So I think each SKU play a different role. So when you talk of family packs, so that is in-home consumption. And that speaks the strength of the brand, because, you will only take product to your house, which the entire family is interested in. It could not be just for one individual. Whereas, the impulse pack, the smaller pack you spoke about, is a one-time or on-the-go consumption. There, it doesn't matter that what your, brother or sister or the family member likes, you want it and you have it. So the smaller pack helps you get distribution. These are the packs which play the role to recruit new consumers, new customers to your bucket. Whereas, the family pack helps you drive volume. So both has a different role. And as we grow, and which is what in fact we have projected, that currently, as I speak, it is 58% business which comes from our family pack. Going forward, this will come down to 55% in another couple of years.
Rishabh, so let's understand the scenario for FY24. There was a
Yeah.
seasonality which kicked in, and last 2 quarters we cannot look at quarter-on-quarter growth. But now that margins have stabilized, they are at 13.3, and the festival curve will start soon, starting from Janmashtami and then Dashera and then Diwali. Do you think this could be a bumper year for Bikaji, because demand and margins, when they both come back, it will lead to operating leverage?
See, so we've done a multiple work at all input metrics, be it setting up plant at across all different part of country in last 1.5 years. Also setting up right team, right systems. So we've done all the thing in the right manner. So this year, of course, you will see last 5 years we've grown at 20% plus CAGR, and that's what we want to build in coming years also.
So Manoj, you're in middle of an capex cycle and cash flows are negative. Will they turn positive this year?
Of course, yes.
When you say of course, yes,
So
how
basically,
much?
you will see.
Will you give more dividend? Will you do a buyback?
So yeah, so our target is to take. See, we as a board have decided to give a dividend to up to 25%. So this year we're given close to 15%, and we'll take this to 25% in coming years.
You have to, let's say, give me a headline, and if the headline says Bikaji Foods to ET now, and this is their guidance for FY24, top line, margin and cash flow. Fill in the blanks. I'm going to make a plate which says Bikaji to ET now, exclusive guidance FY24.
See, we cannot give direct numbers basically, but yeah, see, you will see what we've done in the right manner in past. We'll continue to do in the future. So we've grown at 20% plus CAGR in last 4-5 years. In last 1.5 years, we've done a major capex. So of course, we'll grow at a much faster pace. That's what we want to say.
Manoj,
and from bottom line perspective, of course, yes. So last quarter was 13%, but you will see overall as a year basis, we've done a bit of close to 11%, and that's what we are building the efficiency at all level. Be it doing a work on premiumization of product, being efficiency building across all cost centers. So that's what we are trying to do, and we of course will want to increase this to come in 200 to 150 basis point in coming 2 years.
Manu, let's get the margin FY24 number. Will it be in and around last year's level, or this 13.3 which has come, which is expansion of 300 bips, it will sustain?
See, so we want to see, we are seeing across full year numbers. So full year we're done close to 11%, right? So largely we want to take this to, of course we want to build this and we want to take at least 100 basis point higher. That's what our target is.
Manoj, can I get closing comments from you? You've been quiet.
Yeah. So I mean,
either you don't agree with Rishabh or you want to add something more.
Yeah. Yeah. So last year for Bikaji has been a historic year, wherein we went public, and just not this, we did a lot of things, which would be remembered for years. In terms of the expansion, what we did, I think, the growth, what we could witness is that we set our fundamental right. If I was to put some number, we have added about 100,000 outlets, so reach has increased by that. Now we've added our distributor base. We've added feet on the ground. So there are lots of things which has gone very well, and that gives us immense confidence. That to your question, that how would our next year look like? I think there's no reason that why it should be not better than for what it was this year. So that's what we feel, and we're confident about it.
So on that optimistic note, we'll wind it down. Thank you so much, both Manoj as well as Rishabh, for joining in and sharing with us your projections. That's Bikaji talking about, yes, seasonality is coming into play for revenue on a sequential basis, and 58% of their sales are at large packs. That clearly does help with driving volume growth. Revenue growth will be at a faster pace than 20%. Okay, that's Bikaji at 391. We'll take a very short break. Be right back with lots more corporate voices.
Back with the market right here in ET now, and the market definitely has recovered ground from where it started off. So started off about 0.5% or so lower, and from there we've seen a meaningful recovery come in. There's Dr. Reddy's, Britannia, Maruti, Kotak Bank. They're all holding a buzz. But the brightest stars are within the broader end of the market, where Dixon is now reacting to its numbers. It's holding up 4.5% right now. It's at the high point of the day. Bandhan Bank is higher by about 2%. There's Alchem Labs, which is going strong. A good 2% move coming in there. Biocon is reacting positively to its earnings as well. 4.25% higher for Biocon. That's going very strong. And then L&T Finance as well, which is now, I think, sitting at a 52-week high. That stock is well going strong by a good 4.25% as we speak, 4% on the spot. But here's Prashant Jain, Director at 3P Investment Managers, stating that markets have been flat for the last 18 months, and that's also led to some moderation in market multiples. Here's him telling us what he likes in the current market.
So I think yes, if you look at markets, last 18 months have been flat. They've been range bound. And that has led to, the time correction has led to moderation in multiples. And even globally, interest rates seem to have peaked, at least for the time being. I'm not an expert on that. So I do think that the risks have slowly got addressed. Valuations have turned reasonable. So I would say these are fairly valued markets. But still I would say there is not much room for multiples to go up, at least in aggregate terms. So I would say broadly returns should track earnings growth or nominal GDP growth.
When you're saying valuations are looking reasonable, I'm assuming that you are looking at historical benchmarks?
Yes, if you look at, in terms of PE multiples, typically I think 1 to 2 years forward. So in 3 months' time, we'll all start focusing on fiscal 25. So I think based on fiscal 25, markets are trading between 16, 17 times, which is reasonable, which is not cheap, but it is not unreasonable either. I would say things are just about okay.
Is it a good idea to look at historical benchmark, because history and these conditions, when these PE multiples were there in the past, the conditions were very different. Liquidity, underlying growth of the economy, global interest rates. So is it a good idea to look at historical benchmarks and talk about valuations?
So when I look at historical benchmarks, I look at typically a 15-year average, because that does cover 1.5, 2 cycles. And if you look at 15-year averages, I think we are slightly above that. Our growth rate should improve hopefully as we go over the next few years. I think India is acquiring more and more prominence, visibility globally. It's becoming a large, fast-growing economy. Geopolitically, I think we are in a good situation. We are a good boy in the world.
You've been a big advocate of banks, and especially banks, big banks and banks which have a strong CASA and a big balance sheet. Now that trade has worked like a charm now. What was more like a consensus view has now become a consensus trade, which is overweight financials. But do you think even though it's a consensus view and a consensus trade, the consensus prices has not reached there?
So I think, yes, most people agree now that, and the stock prices have moved sharply. So most people agree that banks are in a sweet spot. Balance sheets are very clean. Trade growth is reasonable. And profitability is holding up well. So I would say these banks should continue to do well. And the gap in valuations across banks, the earlier what we used to call the retail banks and the corporate banks, that has now converged. And actually that divide is becoming less relevant now, because the asset side of almost all the large banks is increasingly looking similar to each other. So I think the re-rating part of the trade has played out to my mind. But this represents sustained growth business. So I think one should be able to make returns in line with the earnings growth. And banks, I think, should grow their earnings medium term slightly ahead than the Nifty. So to that extent, I think there is still room for some outperformance there.
Who has the right to win in the financials?
My vote would be for the large, big brands, that have scale, that have good technology platforms, that have a good CASA mix. And so my vote would be for, I mean, that's an obvious one. And there could also be other smaller niche companies which can do extremely well, like some small banks are doing quite well. But this clearly is the biggest piece where I think the outlook is quite decent.
You know, when I just recall some of our conversations, and it is absolutely amazing that what we've discussed 2 years ago, 3 years ago, markets are recognizing them. And one theme which you've liked in your previous avatar was defense manufacturing. These stocks are commanding P multiples of consumer stocks now. Do you think from a market standpoint, this entire defense manufacturing or railways manufacturing has been played out?
I think again, in terms of the multiples moving up, they have played out. See, 2 years back, these stocks were between 5 to 7 multiples. And today, they are anywhere between 20 to 25 multiples. So I think the multiples re-rating has happened. But these are highly sustainable businesses. They have many growth tailwinds, both support of government, focus on indigenization. And I think the Ukraine war has also highlighted that you need to maintain large inventories of ammunition, because what you produce in a year can get consumed in a matter of days. And I think India also offers you competitive pricing for the technology what we deliver globally. I think the exports opportunity is also there, though it is smaller compared to the domestic opportunity. So I think, again, coming back, it's in a similar position as the banks. The re-rating has happened. Multiples are fair, but you can make some money as the earnings or the business continues to grow.
From one market veteran to another, Sunil Singhania, founder Abacus Asset Manager, says that reducing cost pressures are easing global concerns. He also says that the second half of the year will be much better than what had been expected. Listen in.
One thing we have to remember is that earlier, we used to have a 15-20% move in the market once in 2-3 years. I think we are in a zone where we'll have a 15% move in the market 2-3 times a year. And I think that is the reason you are seeing this bouts of, markets going down and coming up from time to time. The world is very correlated. I think markets are taking a cue from each other, and therefore you are seeing this sharp moves up and down. On the other hand, I think you are right. The things seem to be stabilizing in the world. Our view on oil has always been of a softer oil, and we still continue to believe that oil will settle more like $60-65 than where it was. It's already down to 70. The world also has started to believe that inflation has seen its peak, and as a consequence of that, interest rate has also seen a peak. And on the other hand, you also have cost pressure which companies were facing because of raw material moves and freight moves and also energy costs. They are also stabilizing. And on the fourth side, you have China, which had a very strict COVID policy sort of reopening, and there is an optimism that there will be some growth there. So the world in 2023 second half should be much better than what it was in the last 1 year. And maybe that is a reflection which the markets are basically showing us. As far as India is concerned, result season has been pretty good. Obviously the very obvious sector, which was the financials, has done much more and much better than what was expected. And other sectors have performed in line or better than the muted expectations which the street generally had. And as we move forward, again, the optimism is that with interest rates coming off, so 10-year yields in India are down below 7%. Inflation has hit a significant low post the Russia-Ukraine issue even in India. And general optimism of good growth going forward. And the markets are looking with a lot of optimism. And the last thing is 18 months we have not seen Nifty go anywhere. So we are still at the October 21 levels as far as Nifty is concerned. And in this last 18 months, we have had 6 quarters where cumulative earnings has gone up by almost 25-30%. So the Nifty P multiple on a 1 year forward, which used to be like 24-25 times, is down to like 16-17 times. So overall valuations also seem to be much more reasonable than what they were maybe 18 months back.
You started your opening remarks with a 15 to 20% move it could happen 2 or 3 times in a year. It's like saying that, your birthday may come once in a year, but you will get these big moves at least 2 or 3 times in a year. So if I look at the recent rally, looks like in this recent rally, which is the summer of 2023 rally, it still has some more headroom left.
I frankly, howsoever and how many times we might try, near-term moves are just a toss of a coin. And frankly, don't know. Geopolitical situation in the world keeps on giving you surprises and shocks from time to time. So don't know. But one thing is very sure that the appetite for Indian equity from domestic continues to be very strong. And from the global guys seem to be increasing, quite visibly. And I think that should ensure that markets are not going to come down in a hurry. And if we are lucky and if we have a good monsoon backed by good growth, which is sort of becoming visible, the government's resolve on spending money on infrastructure, which again is very visible, and corporate India also looking at expansion, which is also visible. I think we have a good sort of a mix of both macro as well as flows supporting the market.
Sunil, in your note, and you've just highlighted that the India appeal and the interest towards India is at an all-time high. If that is the underlying mood, then what explains that big fat sell number for 2022? And even for the year, FIs may be back, but the number is still down 29,000 crore on a YTD basis.
So obviously, Nikunj, last 1 year has been a very difficult year. You had the Russia-Ukraine war, oil went up to 140, all the commodities went up sharply. And obviously, India was relatively doing very, very well. And, it's typical that when you have, your view on the global equity markets not being positive and there is one country which does well. So one is the overweight increases and the other is, you tend to knock off what is doing well. So I think that was one reason maybe. And second is, there is no one-on-one correlation on a day-to-day basis that, if they are positive, they will pump in like billions and billions of dollars immediately. It takes time. Obviously, India has always been an expensive country. It was very expensive maybe from their end last year. It is now at a reasonable level. And we are already seeing, this month we are almost seeing close to $800-900 million come into the country. So I don't know whether it will be near term or medium term, but we are very positive that over the next 18 months, we should get back what we sort of lost in terms of outflows over the last 18 months.
Identify some trading ideas, some of the chart buster stocks as well. So let me take it back to Kunal and Nooresh and find out what they've been spotting in this recovering market. Kunal, what's on your radar?
Well, it's a breakout candidate, L&T Finance Holdings, a stock which has crossed about the 3-digit mark for the first time. I think it's also at a 3-year high for itself, which it hit just about a few minutes back. Now, interestingly, the stock has come back towards a major breakout zone. As you can see, the stock had completed a previous swing breakout about the 96-97 mark when it managed to break out of this important resistance. It's forming a classical kind of a pattern. So this is more like an inverted head and shoulder pattern for L&T Finance, which it has been formed over the last 1.5 to 2 years and looks very, very interesting. The stock has come back about that 102 mark so far right now. And going by this pattern, which means that the major supports for the stock is defined at the current levels of 75, and that pattern depth is almost 40 to 50 rupees for NT Finance, which means from a breakout point of 95 approximately, we can expect the stock to get into a further uptrend from current levels. So expecting the stock to gradually break past about those previous resistances of 115 and then 120.25 for NT Finance, a stock which could trend quite strongly over the next 6 months to 12 months.
Okay, that's interesting. Talking about L&T Finance Holdings, Kunal mapping out the charts. Meantime, it's L&T, Nooresh, that you're flagging off.
So L&T is interesting for the fact that the stock has seen a little bit of a dip post the numbers. Now, if you look at a little longer term chart in 2022, it made a breakout above that 2,100 mark, and that was the resistance before. And over the last 4-5 months, 2,100 has been the base. We've seen 3 to 4 bottoms around that, and the base is shifting higher towards 2,150, and hopefully now going forward, 2,150, 2,200 should be a base. So this is a zone where one should be looking out for buying. The longer term charts are still very positive, expecting it to again make a move towards a new all-time high. So buy at current levels with a stop loss at 2,100 and a target price of 2,500 to 2,800.
Right. Okay, and let's get in some stock ideas too, Kunal.
So 2 buy calls. The first one is about Canara Bank. Again, more of a turnaround stock for the near-term play, forming a bullish hammer on the daily charts, recovering quite well. Buy with a target of 320, stop loss at 295. And the second would be about ABFRL. Have been bullish on the stock in the last couple of days, expecting a major bottom to be at place for ABFRL. So buy with a target of 216 approximately, stop loss to be kept at 185.
Okay, Nooresh, let's get in your top calls.
So first is a buy on ICICI Bank, not far away from an all-time high, expecting it to do so. Stop loss at 930, target of 1,050. Second is a buy on HCL Tech, which is structurally setting up for a leadership in the IT pack. A stop loss at 1,080 and a target price of 1,250.
All right, thanks very much, gentlemen, for joining in. Those are all the stock ideas. Hope you took note. Well, let's focus in then on the big event that we're awaiting. We at the Times Network are back, and it's our flagship event. That's the India Economic Conclave, which will set the stage for driving India's economic agenda. As we move forward on the path of integrated, equitable development, which is all-inclusive, all-pervasive, universal, and one that strengthens not just the Indian economy, but the global one too, we want to pursue the agenda for the theme that this year is going to be India, the emerging third superpower. IEC will feature some of the biggest voices from politics, global markets, the economy, and the corporate world. So get ready to catch all the action here on the Times Network.